Okay, what I want to do is just introduce you to Macrograph. I want to show you what the graphs reveal and how to interpret and react to the market-generated information they provide. I'm also going to talk a little bit about the daily signals that I use or daily market profile, just to give you an idea of where this originated from. Back in 1983, I started down at the Chicago Board of Trade, spent most of my time, sometime in the grain room. I went to the Mercantile Exchange, spent some time in the S&Ps, but most of my time has been spent in the treasuries. And while on the floor, I've tried every tool there is out there and used most indicators, or at least researched most indicators. But I ended up choosing Market Profile because it's a tool that best depicts or at least reveals the information to me what I was seeing in the trading pit. And what I'm really trying to do while being a broker on the floor there, my chore was to report price action to institutional traders, fund managers, banks, and they asked a number of questions, but they wanted to know who was moving the market. And the beauty of being on a trading floor was that I could put a name on a trade. I knew when Goldman or Merrill or JP Morgan was coming in. So when the market moved in a direction, when those institutions would enter the market, that's what real momentum is. It's capital flows, and I sorely miss having that information, because really the trading floors right now, I can go down on the board of trade and there's so little trading done in the pits. It's all screen related. So the question is, how do I see on charts what I used to see in the pit? And I believe Market Profile organizes data into a structure that reveals whether bulls or bears are in control, or what the real capital flows are. What the daily profiles allow, they show us what fair value is. I can use them to determine momentum for the short term on a daily basis. Also, I assume direction once I get a read on momentum. And they also help me define risk. This is one of the reasons why I love the tool and use it to this day. It's going on over 25 years now. These are daily bell curves, okay? And I really don't want to get into the day stuff. This is all about Macrograph. But in conjunction with Macrograph, I use daily profiles or market logic, if you will, okay? I don't necessarily you don't have to have Market Profile to read a daily chart. But what it does is it breaks down price action in half-hour bars, and it builds these structures that are called bell curves. And there are a number of different patterns that are very revealing, and I'll use these in conjunction, like I said, with the weekly, monthly, quarterly profiles that I show you in Macrograph. But these are two very common patterns. Most days develop a bell curve, and a bell curve, it tells me that I would say 80, maybe 85% of the days, there's one price that we're going to see trade in 8 of the 13 half-hour periods during a trading day. So that tells us where most of the volume occurs by simply watching time and price. But when I'm looking for direction in a market or a change in direction, these are very directional profiles where I'll see an early high. Let me just show you. Here's my open. These are my high volume prices right here. This is my close. This black line you see tells is roughly the first, what's called the initial balance or first hour of the day. And I watch that carefully because that's when institutions and the big money's in. It's generally your high volume time of the day because it provides the most liquidity. That's when the institutions tend to be most active. Opens and closes, opening hours and closing half hours. But these are, when I see these types of profiles, I know that the market's going to continue in the direction of it. This one being negative, this one being positive. Also, when I'm seeing when a market's ready to roll over, change trend, or go to a coiling phase, I'll see these types of profiles. And we're not going to get, these are things that I teach in my classes, but I don't really want to get into those today. But these are just what sort of the patterns I look for short-term signals, like I said, with the longer-term charts. And these are my favorite. I mean, what trends usually begin when you see these really low volume zones between high volume zones. Those you see a lot of these types of days as the market begins a trend. Now let me tell you how I came across Macrograph. I was using daily market profiles. I used to chart that stuff by hand for years. One day I was working a squawk box, and I was quoting the 30-year bond pit to our offices in Japan, London, Chicago, and New York. And let's say that each one of these profiles was a week. So there's week 1, week 2. Let's call this week 3. For 2, and the bond normally had a pretty good moves in the bonds, and it still does. But let's consider that these are far below average moves vertically. In other words, they're wound a little too tight. And I've got a very noticeable high volume price here. For 2 weeks, the market went nowhere. It was really boring. It was I was sitting there. It was 2 bid at 3. There's 200 aside. 3's trade. There's only 50 left at 3. It's 3 bid at 4, and then it was offered at 4. It was just awful. We spent a lot of time playing liar's poker on the floor during that time, I remember. But then one day, we're sitting around par, and Merrill Lynch comes in and buys 500 bonds. J.P. Morgan following up with 1,000. Goldman with another 1,000. And the market exploded and sprinted away from this high volume area. And it was at that time I had this epiphany and said, oh, this is what momentum looks like on a chart. So I thought, well, if I can understand how to tear apart a day and analyze how to read what's happened during a day, how do I do that by week or month or quarter even? So I thought, well, I'll just use the same logic that I learned using the daily profiles. If I can establish what is a fair price, and then look at those daily signals, if I get a very directional profile for my daily signals, that is the confirmation that that momentum is kicked in. And then how do I deal with it after that? Well, if the market, just something to think about, pure logic. This thing's been sitting for 2 weeks in a row. It's 50% below its average week's range. There's a good chance it's going to move at least a week's range and probably more. Think of it like a balloon ready to pop. It's just ready to go. And all I'm simply trying to do is work with probabilities here. Is when a market gets wound too tight, it's ready to move. If it's moved too far, after it's moved too much, or you get overbought, oversold signals, it goes through a coiling phase. So all I'm really working with here is 2 phases. Is this market ready to move, or is it ready to coil? So I look at different time frames to figure that out. Now, what you got to know about the charts. On the bottom of each chart, if it's a weekly chart, you'll see each day of the week is shaded a different color. So Monday will always be purple. Tuesday is this shade of orange. Wednesday is blue. Thursday is red. Friday is green. Now, if I look at this chart, I really can't get an idea of what momentum is for Kellogg. But if I stack all those on top of each other like market profile does with letters, it shows me what the fair price is. And really, what is momentum? Momentum is the movement away from a fair price. So this is why I want to know what the fair price is for the week, the month, the quarter, the day for that matter. This is how you read momentum. So the fact that the market settled above the fair price here tells me that buyers have control of momentum. Okay, as a broker, brevity and speed were imperative, and I had to have an opinion ready at all times. So I broke down the most common questions traders ask on a daily, even hourly basis. And I came up with a checklist that I use every day when I write my daily updates or my daily bulletins. And I broke it down into an acronym called Vertex. And what do traders want to know? What's fair? What's the fair price? Where's fair value? How do I determine that high volume price? Where do buyers and sellers agree most often? Who owns momentum? That's the energy of the market. It's above in what direction is the market likely to go? Has paper been buying the market? Paper meaning the institutions. Have they been more active buying or selling? Once I'm in a trade, what's my risk? Well, where does momentum change? If I believe the market's supposed to go higher, at what point does momentum change? So where do I get out of my trade if I'm wrong? Is the timing ripe for this market to go on a big move? Or is it just in a coiling phase? Do I implement a mean reversion type trade or a counter trade? Where do I get in? What support and resistance? And last, where do I get out? And getting out is not simply what support and resistance, although that does help. But how far is the market likely to go? And once I'm in a trade that's profitable, how do I retain that profit as the market moves in my direction? So when I approach the market, I want to make sure that I cover each element of vertex, and I should be able to come up with a decent strategy. So as far as fair value is concerned, on occasion when I send you the charts, you will see these staple-looking structures here. What that tells me is what the standard deviation of volume around the high volume price is. And why is this important? Well, I use value areas are one of, if not the main ingredient for defining risk. As the market moves lower, you don't want your risk is defined by the top of value, and as the market moves higher, your risk is going to be defined by the bottom of value. At least that's the most general way to use it. Okay, there are other ways to lock in profits, but for our purposes today, we're just going to deal with the top and bottom of value. How do we read momentum? Momentum is simply the move away from the high volume price. One of the things and I'll get into this a little bit more and show you in the chart, but I always track what the fair price is, and it's not just where the fair price is, it's how much time was spent at that fair price. The dimension of time and price, I think, is a dimension that is not analyzed and used enough in trading. I want to know when a market is wound too tight, just like the example I showed you earlier about when I had that epiphany on how to read momentum. I knew the market was wrapped tight, but what did it look like when the market ran away from it? And quite often when you get these really, really noticeable high volume prices, then I turn to my short-term patterns of directional signals. Tell me, did I get a signal away from a high volume price that tells me that this market is on a move? And you see this really low volume area I'm shading in here? Those low volume areas tell me a lot. It was those trend type profiles that I showed earlier in the presentation. That's what it looks like when a market goes on a run. And just to tell you here, we're looking at months. So remember, each week, each day was shaded a different color. Well, in each month, each week is shaded a different color. And why is that important? It helps me read momentum. I can see here that I'm making a lower high each week of the month. So it just helps me read momentum, like reading the letters in a daily profile. All right, so let's talk about timing. Or let's talk about risk first. As the market starts to move in direction, and then while I'm on it, I might as well point out the support and resistance areas here. We're looking at a 10-year note by week here. And I want you to note that markets momentum begins and ends at high volume prices. So these are spots that you really want to look at. I don't care if you use market profile to get your short-term signals. You can use anything you want. But I think you always have to have a short-term tool that helps you manage a perspective, a longer-term perspective. So here in a weekly profile, now look at under here. You see under each profile, I know these are hard to read in the charts, guys, and I'm building the program so that the fonts will be bigger. I know it's difficult to read right now. I have to actually enlarge my charts to read my own charts, or to read what it says under each chart. But let me tell you what they're saying. It gives me the length, the range of the market. The R in that stands for the range, meaning high minus low. And the W is the width at the high volume price. How much time did it spend at the high volume price? And then what you see at the bottom of each chart is the median width and a median range. So of all these profiles here, the 10-year note moves 1.23, which is roughly 1.8 ticks per week. And it also spends about 30 different half-hour periods you're going to see 30 different half-hour periods trade at the high volume price. Well, let's look at this. On this week here on 4/18, we spent 43 half-hour periods at the high volume price. This market is wound tight, it's ripe and ready to go. Which direction is it going to go? I don't have a clue before the next week starts. But I know that this could be the springboard for a good move. And all I got to say, we come in on Monday and I get a close above the high volume price is a great indicator. If the market extends after the first hour, another good indicator. These are the indicators when institutions are entering the market. And if the low was made in the first hour of the day, that's also a good indicator. So I get 3 reads on momentum that this market is ready to take off from the high volume price last week. How far is it going to go? Well, it should move about at least a point and 8 ticks away from it. Now, you understand the logic on how this works. By using these high volume prices, you're going to be looking for movement away from them. Now, let's say you got long at this point. What's my risk? My risk is that it won't trade below this bottom of value. And then the next week, my stop moves up to here. And the next week here. And the next week here. So by starting a trade where you risk about 6 ticks, you're already up 1.5 or 2 points on it, or roughly 48. So you see the logic. Once you get the short-term signal that confirms a long-term look, you need these to work together. And this is what these value areas help you with. How long can I stay with this trade? Until it trades below a previous week's value area, there's absolutely no reason to be out of that trade. As a matter of fact, the chart we're looking at in the NASDAQ right now, the weekly chart, is very, very similar to what we're looking at here. And the same thing is true when you're in a down trade here. You got the U.S. dollar. This market rips away from a high volume price on a Thursday or a Friday, but you could see, but for months, now we're talking about months here, not just weeks. And how much is this thing going to move a month? It's going to move $2 or, 2 points, almost 3 points a month. This is the idea. How do I make a short-term trade and turn that into a trend type trade? And these value areas will keep you in the trade as long as you stay below that. That defines your risk. So that's what value areas are for. Let's talk a little bit about timing. And timing, I'll just reiterate, we've already kind of talked about this. Here we've got crude oil that normally is going to move $5.40 a week, and it's only moved about $2.50 this week. This market's wound tight and ready to go. You see it comes back into the next week, and it's still wrapped up, wound tight there. I don't know which way it's going to go, but I do know this, that it's not going to spend much more time there. And after a market spends too much time, it moves or it coils. If it's done coiling, moves. And after it did that, it went through a huge coiling phase. And look where this market stopped at. When I look for support resistance levels, I want you to note these really low volume areas. When you come back to visit those, they tend to be outstanding support or resistance. Even if it was by a day, I mean, you can look at this. On this week right here, you got the high volume price that held for a Monday and a Tuesday. And you came back here, it held for a Monday. And on this one, it held for a Monday. So these high volume prices may not be the high or low for the entire week, but they are sure good places. If you're a day trader, not bad places to make bets. Entry and exit points, high volume, low volume prices. And this is the things I try and point out in my daily bulletins where there's a good spot to make a bet. This is the NASDAQ. This is very recent. This is up until Friday. We just talked about this. I mean, this thing hasn't traded below a weekly value area in I don't know how long. What, 7, 8, 9 weeks now? Why would you want to be looking for a place to get short a market that can't even get below a weekly value area, hardly even a daily value area? So this is why it's important to look at a number of different time frames. Hey, we can't get the weekly momentum to change until we see the daily momentum change, and the monthly can't change until the weekly changes. So every weekend I look at quarterly, monthly, weekly, daily charts. I get a read on all those time frames, and then I can make my judgment. Hey, has it moved far enough? Has this market moved? Is it overbought or oversold? I'm sure there are indicators out there, guys, that can give you that. Bollinger Bands, MACDs, all kinds of things can tell you when you got overbought or oversold or when a market's wound too tight. I just kind of put it in pictures. It makes it a lot easier for me to run through a bunch of markets very quickly, and I can glance at a market for 5 seconds and tell you whether it's overbought, oversold, what's my risk, how far should it go. And it's all because of these structures. While we're at it, let's talk about support and resistance levels. Here we got a low for a week off of a high volume price. Here you come back and visit a high volume price. It was a high for a week. Here it was a high for a week. Here it didn't work. Here it was a low for the week. So these are the things that I point out in my daily bulletins. Here's another low off of a high volume price for an entire week. And again, and again. And what's this? A sprint area or a low volume area where the market sprinted away, the visit back to it. And you think about it logically. What did this tell me when this market moved on this Friday here? What did it tell me? That the market exploded. It sprinted away from the fair price. You come back and test, and when it came back and tested that, that's where buyers put up their defense. So when the market goes there, say, hey man, I know buyers were active here before. There's a good chance they're going to be active there again. I'm not giving you anything that you don't know. It's about learning to read what the market tells you. All the information is there. We just have to learn how to read it. Now, as far as profit projection goes, as I mentioned, down in the left-hand corner, there's a median width and range. What this rectangle here represents is the average lengthwise move and the average width at the high volume price. So I'm going to go into some recent charts and show you how I use those. And often I'll send you the stats. How much is the bond moving in the first hour of the day? And why is that important? Hey, if the bond moves an average first hour range, if it moves average, there's a very good chance the market's going to develop a bell curve that day. In other words, it's going to find a price that it's going to visit 8 of the 13 or 9 of the 13 half-hour periods we have during the day. If it's a below average first hour range, the odds or the probabilities for a trend day type day to occur where the market just keeps probing either higher or lower as the day goes on. It just keeps going higher, never really reverses much, that kind of thing. You see those types of days when your first hour range is far below the norm. I'm just working with probabilities here, okay? And if you see a whole day's range in the first hour of the day, think of an employment number. You see in the treasuries especially, if you move a whole day's range, an average day range in that first hour, what's the pattern that's likely to follow? It's probably going to build a bell curve, and it's not going to extend much more. In other words, the whole move is already done. So you can go into counter trade mode. Don't go into trend trade mode. You're going to start buying highs and selling lows. You counter trade those type days. Again, probabilities. I don't know if it's going to work all the time, guys. I can just tell you that these things probably are going to work. I built an automated trading system called Vertex, and it goes off of these rules. If a certain type of range occurs in the first hour, we're going to react a certain type of way. And I think the thing's running at 7 out of 10 winners is how it runs. It's a pretty solid system. Okay, so we went over all the things in Vertex, and that's really what how I write my daily bulletins, how I analyze the markets in many different time frames. I believe patterns repeat in all time frames and in all markets, and just to show you how often bell curves form, we're looking at yearly profiles of the S&P index. And I know the colors are difficult to read, but I think it's most important to know where the market closes at, and those are the black ones, which is December. But each month of the year is shaded a different color. But I think I show this more to show you that these bell curves form more often than not. So when I go, as a bond trader or being on a trading floor in a pit, I was only allowed to trade one pit, one market. So I had to try and make the best out of one market, and sometimes I didn't understand what the heck was going on. The beauty of having screens in front of us is that we can trade any market on earth virtually, or any commodity. And so I think that my approach has switched from trying to be just a bond trader or just an S&P trader, is that I search for patterns like this that make sense to me. And when I find a pattern that does that, then I turn to my short-term indicators and say, hey, is it giving me the signal I'm looking for? Yes, I'm getting sellers below the high volume price. I'm short this market. So I will search every commodity, ETF, for patterns that make sense rather than just trade one market. If it doesn't make sense, I'm not trading it. You'll see how often these high volume prices, we could just point out, revisits the high volume prices or support or resistance. You can see that for entire years. And I think the low this year is off the high volume price from last year so far, by the way. Vertex is a versatile tool, guys, okay? And I don't believe that every day you should be analyzing. Oh, by the day, I'm going to analyze it by the week, the month, the quarter. Sure, that's a good way to break it down. But I truly believe that fundamentals move the market, so forces of supply and demand. So sometimes you want to break down the market into where you know there's event risk, and this is an ideal picture here. What I've got here are profiles, and each profile begins on payroll Friday. The first Friday of every month, we get the jobs report. And notice, and that is shaded in green in each one of these profiles. Notice how often the low or the higher the month, or the next, until the next number comes out, that this number establishes the direction for the market. So a lot of times it's good to, with this tool that I have, I can break down a market, say, I want to look at GM from one earnings report to the next, and to the next, to get an idea of what fair value was from earnings report to earnings report, or from one crop report to the next, or from some major fundamental event. So it's about understanding you organize price action into a structure that allows you to make judgments. And that's pretty much all I've got to say about that stuff. So I'm going to get out of the slideshow here and show you a few pictures that I put together this weekend, just to give you an idea of what I go through, or what I like to do. So, all right, these are all the charts that I did this weekend. Let's just concentrate on a few. Let's go to S&P, since that seems to be the most popular for everybody. Let's start off by looking at it by quarter. Okay. This is the quarterly profile for the S&P. Now, this, I mentioned before, this rectangle that I have, that tells me right down here, that rectangle represents the average length and width of a quarterly profile. So the way I use this is how I project how far a market might go. I'll take this profile and I'll put it up against the high volume price. Say, listen, I've got positive momentum above the fair price. If this market just does its job, a normal bell curve, then it's probably going somewhere around 1390, 1395, say, for this quarter. So now I've got positive momentum. The thing closed above the weekly high volume price, the daily high volume price, the monthly high volume price. I've got no change in the daily profiles, those neutral type profiles. I'm looking for a neutral type profile, daily profile, to tell me that maybe this market is spent or exhausted, or that it's gone high enough to entice sellers. I've got no such price action. So we look at it by the quarter. Now we look at it by the month. And we see by the month, if we go, let's take a quick look at that. If we go, okay, so if this is an average monthly range, and I'm taking my measurement from the high volume price, this thing's, and we're talking about this thing getting into the 14 handle. Or even if I took that measurement from the bottom of value from the previous month, it still has room to go. So now my quarterly view and my monthly view are confirming there's no reason to be out of a short or long position. So now we go to the weekly. And by looking at the weekly, we'll see the same thing. Let's make another little box here. Okay, how far is this thing going to move this week? Well, let's just measure it from the bottom of value. With momentum doing well, we're still talking about the S&P probably getting into the mid 13, say 1375. Now, this is a projection. I don't want to call it a prediction because I don't believe you can predict the market. You can only react to what you see. And anybody that tells you they can predict where a market's going is lying to you. But we can project by using probabilities. And as long as I don't get a close below a daily high volume price or a high made in the first hour of the day, I don't get a change in daily momentum. There's no reason for me to think that I should be short that market yet, that there is room to run. So this is the logic behind the tool and how you use it, guys. We could go over. Let's go over. What's pot? Oh yeah, crude oil. Another one. Let's take a look at crude oil real quick. All right, I'm looking at crude here. We're talking about a market that actually is wound up. I mean, this thing has moved somewhere around 22 bucks. I'm looking for $23 move per quarter. Okay, about $23. And I'll also say that at the high volume price on a quarterly basis, the high volume price is going to trade 18. See right here, 118 visits to the high volume price. Well, over the past 2 quarters, we have built an awful lot of volume right here. All right, technical difficulties. I'm sorry, but the point is that already in this quarter, and in this one, that it spent enough time at the high volume price. Somewhere, let's call it 100. Okay, let's call it 100 as a fair price over the last 2 quarters. It's just about done its job. We've seen 103 half-hour periods trade at the high volume price. This thing is far short of its average move. What is the potential that this thing? Where's it going to go? I don't know where it's going to go, but I can tell you this: that it closed up here. This market's got plenty of room to run. Where's it going to? Where's this market likely to go? Well, I don't even see a resistance level until about $107 a barrel, and that's just where sellers were in roughly a year ago, sometime in May of last year. Because May is this green color here, so in May, this is where sellers put up their defense again. It's also the top of value. So I'd expect some resistance somewhere between around 107.50. But ultimately, I would think that this market certainly got the potential to get up in this, revisit this high volume area of 115, and it kind of confirms the fundamental views that are going on with the problems in Iran. I mean, I can't even think of a reason to get short crude oil until it showed me an offer below 103 on a closing basis. That would be just a daily signal. And a weekly signal probably below 102. So absolutely no reason to be out of a long position in crude oil that I can come up with. The monthly charts sort of confirm the same thing. You're talking about over a 3 or 4 month period, a market that's wound really tight and not really doing. The thing moves somewhere almost 14 points a month, and we're stuck at a 6 or 7 point range. This market, and it's got momentum away from that. And what's in the way here? All we got, I mean, I don't see any real resistance here until about 115. When the market gets into these low volume zones, they tend to run through there very quick. They'll stop at this low volume price. They'll stop there for a day and stop there for a day. But ultimately, markets will move until they run into another shelf or another high volume zone. I don't even think we need to look at the weeklies, but let's look at them anyway, because that's why we're here. And the weeklies, honestly, I couldn't give you a clue on the weeklies. I mean, this is a messed up chart. I wouldn't even know how to trade this thing on a weekly basis right now because it's been so erratic. But what I can tell you right now is that the other 2 time frames and what happened last week, the finish up here, the closeout on Friday, you know, it just tells me that this market has not gone high enough to entice sellers yet. And I think there was one other market I wanted to bring out today. I'm sorry, I wanted to go about 35 minutes, so I'll just give you one more. Oh, a lot of people have been looking at the euro currency. Let's just take a quick look at that. Okay. Gosh, I really want to do this one here. I hope I can. Oh, okay. Draw mode. All right, so here's an average quarterly move for the euro currency. Now, if we were to measure the quarterly move from the high volume price there, you see where this market came down. I mean, it had a move from the previous quarter all the way down here. It got pretty near the objective. And then, now what happened when it got down here? When it got down out near those lows, that's when you start looking at, okay, it's near a support area, or it's done its job in that direction. Where at this market, we should start looking for changes in momentum as it nears the quarterly potential. And inevitably, what you're going to find at that point is that you'll start to see neutral daily bell curves, where you'll see, you'll see that first hour trade, and you'll get an extension up and an extension down below it. You'll start to see closes above the high volume prices of the day instead of below the high volume prices of the day. These subtle changes confirm when a market's ran out of steam. Okay? So it's always good to have a long-term perspective and let your short-term tool give you the answer. And again, I don't care what tool you use. If you like to use 10-minute bar charts or whatever it is, a short-term moving average, it doesn't really matter. The point is that if you don't have a perspective from the long term on how far a market is likely to travel and when you should expect reversals, then you're doing it wrong. Without perspective, you're just, day trading is tough enough. And as a matter of fact, I built this system so I could get away from day trading because it's exhausting. 3 hours of day trading, point-and-click trading, will wear a man down. It did to me, and this is why I built a system that allows me to look for trades that I'm going to be able to carry for 2-3 days, maybe even a week, possibly a month. How do I ride momentum and carry me to find my risk, trail my stop with it, and sleep at night and not have to be up at 24 hours a day watching positions? It got real tiring. Let's see, by month here, the euro currency. I'm seeing a market that's going into a coiling phase. And look at here, we're talking about, this thing got right up to the top of value from the previous month. I'm telling you, to me, it looks like this market's going to go into a coiling phase. Oh, one of the things another beautiful thing I like about Macrograph is, you see this low volume zone here? Where there was no volume right in here? I'll tell you what, if you like to trade options, these are great things. I call them claws, where you've got a high volume price here, and you got a high volume price here. A lot of times when a market gets in these, it bounces off these things like crazy, drops volatility. If you're an option trader, good for selling strangles and straddles. You don't have to have a directional bias. You just use these strikes, and you collect volatility while the market develops value within that, plugs up that low volume zone. Just a really neat little pattern that I like to watch when a market gets caught between two high volume prices. It's like a super ball bouncing off the top and bottom of it, and there are strategies you can make money with that. And I don't want to get into that. But anyway, guys, so that's really how I use Macrograph. I appreciate you coming, and please send me any questions you might have, and I'll do my best to answer them. There really isn't time to answer them today in this show. So, well, thanks for coming, and I'll let you know when we're going to have another one. We're going to try and do these things where we're going to analyze. We'll go over the markets, the popular markets. Maybe we'll try and do each sector, where we're going to watch a treasury, an equity. We'll watch an energy, a metal, a grain, a currency. We'll try and cover everything so we all have a pretty good idea. All these markets are interrelated too, so it's always good to watch a number of different interrelated markets. Sometimes one market, you might be trading the S&P, but the euro currency will give you a breakout signal, and the S&P reacts to it maybe a little bit later or something like that. So believe me, that's what professionals do. They're watching a lot of different markets, and well, we should too. So thanks for coming, and hope to hear from you soon. Okay.